Wilmar International is one of the popular Singapore stocks that I always see pop up in financial analyst report. If we see the historical share price, year to date it has dropped double digit for the year, while it has dropped from a high of $5.50 back in 2021. So in this video, we will analyze through Wilmar International business and their financial performances. Wilmar International is a leading global agriculture business group with a strong presence in Asia. Wilmar business has a lot of processing of palm oil as well as tropical oils and fats. They also have operation in processes such as sugar milling, oilseeds crushing, grains, rice milling, and packaged consumer products. Essentially, Wilmar handles a large variety of products from their raw state to the finished good. Their business is vertically integrated from the upstream to processing and to the final product. In the upstream section, Wilmar International owns and operates oil palm plantation, sugarcane estates, and other agricultural assets. In the midstream processing, they convert the raw materials into various products such as palm oil, refined oil, sugar, and flour. In the downstream, the company distributes these products to consumers through different distribution networks in different countries. This vertical integration provides Wilmar with a competitive advantage by allowing it to control the supply chain from the farm to the end product. So how does Wilmar categorize their businesses into three sectors in the financial statements? The first sector is the food products, where they offer consumer products such as edible oil, rice, flour, sauces, condiments, and such. The second sector is the feed and industrial products, which is their largest revenue section. It offers a variety of products such as tropical oils, which are a mixture of products from home care to personal care, lubricants, and biodiesels. Oilseeds and grains are also another sector where they process raw seeds into animal feeds and edible oils. The last sector will be the sugar and soy protein, which are for consumer and animal feeds respectively. The third section is the plantation and sugar milling. This sector is where they own plantations in Indonesia, Malaysia, and Africa, where they farm and process sugar canes to produce various products. These three parts of the business essentially form what Wilmar is today. I've provided a very brief description of these three sectors, and if you're interested, you can actually read more in their website. With all this in mind, it's crucial to note that the performance of Wilmar International is influenced by various factors such as commodity prices, currency exchange rate, and global economic conditions. Therefore, when it comes to investing in Wilmar, investors, in my opinion, should understand the commodity market because the performance of Wilmar is closely linked to the prices of commodities such as palm oil, sugar, and other products. Now that we have the better understanding of their businesses, let's take a look at their first half result for 2024. Looking at their earning highlights, food products revenue increased 77% year over year, which is very impressive. Feed and industrial also increased 34% year over year with increased sales volume, but was offset slightly due to lower commodity prices. Plantation and sugar milling dropped 14% year over year due to India policy changes and poorer weather conditions. If we look more in depth into the respective sectors, food products revenue actually dropped 4%, but sales was up 7%. However, this led to significantly higher profit, largely due to lower raw material costs due to declining commodity prices. Next, for feed and industrial products, sales volume was up 8% year over year with increases across the board. But revenue still came in lower with oilseeds and grains dropping significantly by 15%, while sugar is the only bright light growing at 27%. Profit, however, came in higher at 34%. Why? This might be because sugar contributes with a higher margin compared to the other two. That's why it resulted in the increase in profit in the overall section. For this section, the commodity prices dropping will negatively affect Wilmar. Unlike the food and product section where lower commodity prices will equate to lower raw material costs and larger profit margin. My concern is that if we look at the commodity prices for sugar, it has dropped from 2023 highs back to 2022 in recent months. So this might negatively affect Wilmar's profit margin in the coming quarters. For their plantation and sugar millings, they have revenue declining 30% year over year, sales volume declining as well at 14%, and ending up with profit dropping 14%. Sugar milling performance was affected by policies from Indian government, while oil palm plantation margin was better due to lower plantation costs. Poorer weather conditions was also one of the factors that affected the quality of the plantation fruits and the productivity, therefore lower revenue. For general companies other than REITs, I will usually look at their profit margin for the first glance. For financial year of 2023, product margin is at 7.5%, while year 2024 has a product margin of 8.1%. After accounting for all the expenses, margin for both years comes in at 1.8% and 1.9% respectively. This is actually very low for companies that would like to invest in. Moreover, the profit margin will be expected to fluctuate as commodity prices fluctuate for the respective sectors of their businesses. Another concern I have is the drop in contribution from China, which is their largest contributor in terms of revenue for the country. It has dropped by 13% year over year, which is a big concern. To add on to that, China's economy is not doing well, which might have been affecting their sales. If we compare 2023 and 2022 results, revenue in China has been consistently dropping with 10% year over year. With their largest revenue contributor country declining year over year, their revenue will most probably continue experiencing drop. The positive note is that if you see Wilmar as a potential dividend play, at the current dividend of 6 cents per share, dividend payout ratio is only around 46%, which is decent. At this payout ratio, Wilmar International should not have any issue in sustaining this amount. However, with the potential of the drop in their income, their dividend payout ratio might increase. At the current share price, its dividend yield is about 5.5%. So in conclusion, what can we summarize from Wilmar International's analysis? Firstly, prices of commodities will affect Wilmar International. Therefore, investing in this company will have to take note of the prices of commodities as it will affect their margins. Second is the declining contribution from their China businesses year over year for consecutive years. Hopefully, as China economy recovers, Wilmar International business in China will also improve. Third, poor weather conditions will also affect their plantation businesses. Lastly, with the current income and the dividend payout ratio, Wilmar International will have no problem in sustaining this dividend. Thank you so much for watching. I hope this video gives you a brief analysis of how Wilmar International operates and what are the key parameters to take note of. If you like the analysis, please support the channel by hitting the like, subscribe, and comment on what you feel about Wilmar International business. If you have enjoyed the analysis, you can watch my other analysis on companies such as Singapore banks and REITs. Thank you, and I'll see you in the next video.